Hello and welcome to the Professional Home Buyer Seller series of videos. I'm Pete Denboer, and with my business partner Beth Campbell, we are the Community Realty Group. To view additional videos in this series, simply go to our website at www.thecommunityrealtygroup. We hope you enjoy the show.
I'm here with Matt Burke of SunTrust Mortgage, and with over 8 years in the mortgage industry, Matt has the understanding and expertise to help you as a first-time home buyer, a refinance, or move-up buyer get into the home of your dreams. Matt's got a solid understanding of the real estate market here in our area, and with his guidance and expertise, your closing should be just as smooth as it can be. I'm with Matt Burke, and in this video segment, we're going to talk about closing costs. Matt, first of all, can you please tell us what closing costs are?
Sure, Beth. Closing costs are fees charged by institutions or entities to get a loan and a buyer to the closing table.
And what's included in the closing cost?
Well, typically there are 3 categories to closing costs. First are your mortgage fees, which essentially help the mortgage lender get that loan to the next step. To the closing table. They consist of origination fees. The origination fee is how the loan officer, myself, and the bank will make some money, their percentage of the loan amount. Then there are also other fees that help support our staff, processors, underwriters, which we'll get into later. The next category of mortgage-related fees are fees that go to outside vendors to get the loan to the closing table. For instance, an appraisal fee. The properties are always appraised by the banks. They want to know what the value is. Those appraisers charge fees. Those fees don't go to the lender. They go to an outside vendor, the appraiser. Credit reporting fees, that's another form of an outside vendor. We pull a credit report from an outside company. They charge a fee to do that. Those fees don't go to the bank. They go to those credit agencies. Those are examples of outside vending fees. The third category of fees would be your title fees. Title fees, which are also not part of the mortgage side of it, but more the closing end of it, go to the attorneys, the closing attorneys. They have their certain fees. They charge for title search, they charge for lender's title insurance, and owner's title insurance. Those are your main 3 categories of closing costs.
And Matt, what if it's a cash sale?
Well, if it's a cash sale, then obviously there's not a mortgage involved, so the closing costs are going to be considerably less. You're mainly just going to have the title aspect of fees. You're going to have your closing attorney fees. The attorney is going to again pull a title search. Most likely, even though it's optional, the buyer would want owner's title insurance, which the attorney will secure, so there's going to be a fee there. And then Georgia wants their piece of the pie. They're going to charge their intangible tax, which is a percentage of the sale price, and then also the transfer tax, which is a percentage as well.
And if I were a buyer and I wanted a survey on my property, which I highly recommend, can I get that to be included in closing cost? Absolutely,
and those are typically ordered through the closing attorney because they secure those through the title insurance company that they use. So absolutely, they can include the survey fee in the closing costs.
Fantastic. Matt, who pays the closing cost?
Well, Beth, closing costs aren't set in stone on who pays them. They're typically negotiable, and usually there's 3 categories of people who can pay them: buyers, sellers, and the lender. Typically, if you are a seller and you want to be competitive in this market, you're going to need to pay some closing costs, but they are negotiable. If there are circumstances where a buyer cannot pay closing costs and a seller refuses to pay closing costs, there is something called lender paid closing costs where the lender pays them, but that typically means a higher interest rate to cover those costs.
Is there a rule of thumb for an expected amount of closing costs that are paid?
Not necessarily, Beth. They're typically a percentage of the loan amount. There's a couple fees that are hard cost fees that do not change per the loan amount. Appraisal fees, processing fees, recording fees, attorney fees, but then there are some fees that are percentage. The origination fee is a percentage, the intangible tax is a percentage, and titles insurance is a percentage. So no, to answer your question, no, there's not really a set amount of fees to consider. It's going to be a percentage.
I know as a realtor, a lot of times when I'm out with a buyer and just trying to get a rough guesstimate, I run on 3% or less. Is that safe for a buyer that's trying to think of how much more money they're going to need to come to the closing table with?
It's going to be more safe on lower loan amounts, because once you start to get into a higher loan amount, those percentage-based fees considerably increase. So once you get into higher loan amounts, that 3% might not work. So it really is going to make more sense for you as a realtor, instead of talking to your buyer and giving them some set in stone number, to have them talk to a lender to get exactly what those fees will be.
Absolutely. And then they know what they're qualified for as well before we take them out and
Absolutely.
have them fall in love with the house. Matt, can third parties pay closing costs? Can Fannie Mae or Freddie Mac or family, friends?
Well, not friends.
They won't be friends very long, will they?
No. That goes a little bit back to what we talked about on lenders paying closing costs. You brought up Fannie Mae and Freddie Mac. Really, the only time that they can pay closing costs is if they are the actual seller, meaning maybe it's a Fannie Mae or Freddie Mac foreclosure, where they are the selling institution. They can pay closing costs. Again, lenders can pay closing costs if need be. Regarding family paying closing costs, it does depend on the loan type. FHA, which we will get into later, is a little more lenient on where funds can come from for closing, and FHA does allow family members to gift money for a closing cost or down payment.
And you have to have a gift letter, do you not, from that family member stating that it's a gift?
You do. You have to have a gift letter stating that it's a gift and that it will not be paid back by the giftee, and you always have to source those funds as well from the giftor.
Matt, I'm not sure if this is the right segment to ask this question in, but when you're buying a house and you have to come to the table as a buyer with your down payment and closing costs, does that money have to be in your account for a certain number of days prior to closing?
Well, the general rule of thumb is 30 days that it has to be sourced. Well, let me back up. It doesn't necessarily have to be in the account for 30 days as long as it's sourceable. If it's something that's not sourceable, then it needs to be in that account for 30 days. And in some loan types, 60 days is required. But for instance, if you have a bank statement that has within that 30-day period, that has a large deposit, a $10,000 deposit, as long as we can source that from somewhere, that's acceptable.
Like a paycheck.
Right, a paycheck, a gift from a relative, a tax refund from the IRS. Anything that's sourceable. If it's cash, that is not sourceable. That's a big issue in underwriting. We can't source cash. Cash opens up fraud possibilities. So as long as that deposit is sourceable, it doesn't have to be in your account for 30 days.
Thank you for watching our video on closing cost, and thank you, Matt, for your contribution in this series. We greatly appreciate it. For more information on closing costs, foreclosures, anything to do with real estate, please visit our website at communityrealtygroup.com, and there's a full series of videos to help you buy your next home or sell your next home. Thank you.